Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
Saturday morning, once again, welcome back for another weekly market recap. Now, the week was relatively calm all across the board, essentially. Markets just kept on doing what they were doing before, so a week with no huge announcements, especially coming out of the US administration, and God forbid, at least no new geopolitical upheavals. If not some sort of a civil war starting out in North Africa. I guess it was Libya, if I'm correct. But as for the rest, not something which could really impact the market, luckily. Now, I mean, luckily for us, not for the people living in those regions in the world. But let's start out as usual with the economic calendar, and let's check out the main three data points which were important this week. Now, we got CPI, of course, on Tuesday. Um, I thought maybe I'm mistaken, but I thought usually it was coming out on Wednesday, but doesn't really matter. But anyway, we've seen CPI, both the headline and the core. As for the monthly read, they both came in at 0.2%, so 10 basis points below expectations. And the year-over-year read, especially for the headline, fell to 2.3. It was expected at 2.4. So, slightly disinflationary type of month. As for April, now, if we then go and try to check what was the main contributor to the CPI, it was, of course, again, shelter. Shelter is a very laggy component of the index, but it moves quite slow more often than not. So it takes time for it to get back in line to what the rest of the basket is doing. Okay, but nonetheless, disinflation just slightly. But if you check the trend, right, we're still in a disinflationary type of environment for now. Again, disinflation is not deflation, so I get why people are a bit upset because we are talking about, yeah, I mean, inflation is no longer a problem, but they see prices which are just going higher and higher. Yeah, it's just the rate of change, it's slowing down, so they are still going high or higher in this case, but they are going higher slower to what they were doing before. So, it's a bit of good news, but it's not really good news, I guess. Okay. Now, another component was, of course, energy prices, which came down, but usually the BLS, there is, even in this case, a little bit of a lag from the moment energy prices, like we always checked oil, for instance. So there is this lag component in between the moment those prices start to come back down and the moment that the BLS pick the change or the rate of change up. So usually it's a few months, 2 or 3, don't remember correctly. I'm just gonna try to slap a screenshot onto it so we can see the actual data. Um, you know, I might want to include a little bit of a decomposition of the index so that we can look at the different categories and how they impacted this read, and what was the trend compared to the previous months, just for the sake of it. Now, moving on, we got what? There was the PPI. So PPI was interesting a little bit. Now, usually they're not so huge. They're tied to inflation, of course. They just track the side of the producer, as the name would suggest. PPI, it's just, what was that? Pro Producers Price Index, if I'm not mistaken, once again. But again, the major warning in this one was that the impact of tariffs would have started to creep in on the companies and the manufacturers. So, the fear was that if you've seen CPI as a whole, so for the consumers being relatively stable, it's not slightly down, and PPI would have come in higher than expected. That would have meant that basically companies were suffering the inflation and they were not able to pass it on to the consumers. So they were sucking up the tariffs. If they suck up the tariffs, of course, it's not kind of a dead sentence with just one data point, but that could mean that we are going to start a trend where companies are going to eat up the tariffs. Therefore, the bottom line, as for earnings and revenues, would be impacted. And of course, investors, they look at it. It wasn't the case, as we can see, because at the end of it, the month-over-month read came in at minus 50 basis points versus the expected positive 20 basis points. So, that was kind of a huge miss, all right? And even the core, which was expected at 0.3, came in at minus 0.4. So, again, at the end of it, this concern about companies having to eat up the tariffs, it seems like for now it's out of the question. Now, we don't know the full impact of tariffs, especially because we keep on hearing many different things every week. Now, tariffs on, tariffs off, 90-day pause, and then we'll see. So we don't know what's going to happen. As for what was established for the EU, I guess we'll find out soon enough. But we just kind of struck, I mean, the US administration, not me, of course, but we struck a deal sort of with China to at least bring down a lot the tariffs at least at the current moment in time. So of course the market was happy, and now the market is saying that we got disinflation for consumers, and even for the producers we got disinflation. So far so good under that front. But not gonna lie, it's just my thesis has always been for disinflation currently and for the next months, probably throughout the end of 2025, at least in my view. But again, so not bad. I mean, the calendar doesn't give you the year-over-year read, but I remember that it should be 2.4%, and after the revisions which were made to the previous month, which was revised higher, 0.4%. But it's kind of logical because we got these front run of tariffs. So probably the majority of the purchases were made before. So trying to front run the entire phenomenon here. So now we are kind of see call it the payback stage, right? It's just we just pull demand forward. So now, of course, we are not going to have the same impact of that demand because that already occurred, right? Lastly, the retail sales, which I mean, I usually discount them a lot. Like I don't really look at them quite religiously as I do with a few other data points, but nonetheless, they came in at 0.1%, and it wasn't huge. I guess where is it? The actual data. If I can find it back, I think I just skipped it. Year over year. No, I was looking at the month over month. Yeah, 0.1%. There you go. So the previous read was 1.7%. Again, even in here, you can see the impact of the front run of the tariffs. So, again, I think there is no need to talk a lot about it. Might be another one where I slap a screenshot onto it, and you might have a bit of a deep read in which categories were up, down, flat, whatever. All right. So that would be it for the economic calendar. And now we are ready to jump into the charts. So real quick with the DXY again. Now we've seen on Monday on the back of this deal, which was struck with China by the US. I mean, it's unclear who was the winner. I keep on thinking it was a bit more advantageous for the US, but nonetheless, it was surely advantageous for China as well. But on the back of it, we've seen the DXY having this little bit of a run up right on Monday, okay? So at the weekly open, and then it spent the rest of the week just drawing it back. So I mean, we have been talking about these backfield for a long time now. I guess it has been like 3 weeks maybe, basically since where we started approaching these levels. And it looks like, I mean, if you give it time, at the end of it, more often than not, price action tends to confirm. It just need to be a bit patient sometimes. So the most interesting thing right now would be what's next. So can we see the dollar now? Or, I mean, the DXY, not really the dollar, but the DXY holding this level and keep on grinding to the upside? Or is this the time where we see a rejection? Quite honestly, I don't truly believe in a rejection. My expectations, at least at the current moment in time, would be a bit more of a choppy action and another push to the upside, if anything. But I don't truly believe we are gonna just collapse from this region right here. All right. Now let's have a look at foreign currencies. So the euro again, nothing really moved a lot. It's just mimicking what the DXY did, of course. So sharp move down on Monday, which was expected. Okay, so we discussed the relevancy of the area below to provide a little bit of a preliminary support when retested. It looks like we immediately bounced off of it and we spiked back in into that apex base, which was confirmed, if you remember last week, was broken, retested, and confirmed as an initial rejection. And then we got the actual, let's call it, breakdown. It's not really a breakdown, but it's just price moving away from the base and now being stuck in between that apex base and this tiny, I mean, it's not really tiny, but you could call it a little bit of a shelf, which was created on the way up. Okay, so a little bit of a trap fractal maybe for now. So it depends on what type of fractal do you think is the most prominent. Uh, by looking at it at first glance, I'd say there is maybe more liquidity in this one rather than this one. So could it be we got a little bit more of a push deeper into this one? So we just tapped into the shove top. Mm, would you see a run down to at least the shelf middle, kind of like in this pocket right here, or maybe around this point of release right here? Because I do like this kind of a dodgy before the release, so maybe around here. It could be if the DXY gives another push to the upside, right? As for the pound sterling, again, kept on distributing a little bit. And now it's a bit, at least this week, it was a bit relatively stronger compared to the euro, okay? Um, Japanese yen, same, came back down on Monday, and then it spent the rest of the week drawing back this move to the downside and got back into the range. As for the rest, there is really nothing to say. I mean, the Australian dollar was just in this trading range again. The Canadian dollar just came back down a little bit. So now the question becomes, uh, can we try to put in a little bit of a rounded reaccumulation and shoot to the upside, or this is just a normal distribution, whereas now we drift a bit farther south. I would say probably a bit farther south. We'll see. Currencies are more often than not, they're also, when it comes down to impulsive moves, they're also moved like what's going on in between the geopolitical type of relationships. In this case, it could be mainly in between Canada and the US, right? So we'll see about that. As for the other currencies, uh, tiny particular movement in the Chinese yuan, okay? Because we've seen the DXY moving to the upside. So, you would expect in this case, the Chinese yuan versus the US dollar to move down. But again, another testimony that at the end of it, the DXY, it's really massively all weighted toward the yen and the euro. So on the same day, Monday, you've seen the CNY going up, Chinese yuan going up. Again, on the back of the news of the sort of a deal in between China and the US. The Indian rupee, it bounced and then it failed. The South African rand is climbing to the upside. The Brazilian real still grinding to the upside, a bit weaker compared to this one above, but nonetheless. The Russian ruble, it's is it going up? Yeah, it's going up again. So it looks like what we've seen was kind of a very good medium-term bottom. We just hit resistance right at this apex right here, initial rejection, and then we kept on going to the upside. I wasn't really paying a lot of attention to the Russian ruble to be quite honest with you, right? But it looks like that's what happened. Now let's move on to oil. So again, oil, what was the assessment? The double bottom was confirmed last week, so at this point, a run at the highs in the forecasted range bound environment, it was kind of in line with expectations. So it looks like this is exactly what we got. Monday, Tuesday, we ran at the highs. Now, again, if you remember, I said it doesn't mean that we have to necessarily taking them out or breaking out, but just by the nature of these range bound environment, if you're coming off of the lows after confirming a double bottom, it's just natural that the progression should be getting back to the high side of the range. And again, we, at least for now, we just confirmed that we want to stay in this range. So what's next? Well, up until it works, it works. So, the range is the range until the range is the range. So I'd say a little bit more of a choppiness. Quite honestly, it's a kind of a wide range. It goes from 63, 64 down to 56, 55. So it's a tradable range intra-week. And I guess, up until the point it doesn't break, we just trade what we see. I mean, if you do trade it, I honestly, I don't personally. But again, overall, I'd say my macro view on this never changed, and it hasn't changed yet. Even if we get a little bit of a spike to the upside toward the 66, 67 region, I would still expect a little bit of a rejection at these levels if we ever retest them in the short term. All right. Other than that, I don't really have a lot to say on oil as well. As I said, the markets just kept on doing what they were doing. So there is really not a huge amount of things to discuss. Now let's have a look at gold, because gold was a tiny bit interesting. Now we had the weekly open, which was a gap down. We tapped back into this level right here. This time around, we got a little bit of a tiny bounce, and then on Wednesday, we really pushed into the level. Now, here's is where, if you remember 2 weeks ago, I zoomed in on the 4-hour chart, and we were looking at potential, bouncing areas in this region because, we just drew this type of a circle, or is it really a circle? Maybe it's a what, eclipse, right? And we said, yeah, I mean, throughout all this range, there might be potential bounce opportunities, but where would they be? And I do remember we highlighted these 300, sorry, 3,150 region, which basically was kind of like this one right here. Okay. Now, sure, when you do things like this, it's hard to get particularly granular and, super precise. But, although the region was 150, so to speak, and price spiked down $15 lower, more or less, you can't deny that at the end of it, overall, the area in the big picture kind of gave the reaction you were expecting from it. Now, the other one was, of course, this one right here, which wasn't tested. So the first type of region was confirmed as a good support, or at least, more than good for a bounce. Now, the question now becomes what's next? Because we tapped right back into it. We bounced on a Thursday, but then again, Friday was a little bit of a failure of that bounce, of a fade. But nonetheless, we ended up the week with a little bit of a strength, which, to be honest, we didn't even reclaim this leg down. So probably a bit of weakness in gold at this point. I mean, or at least, it was trading in between the highs and this low, so this dealing range right here. Now, it looks like we violated it, and probably we might see a bit more of a push to the downside over the coming days, if not weeks. Uh, it might be, of course, you shouldn't discard that we might have another little bit of a bounce before actually tap deeper into this pocket right here. But what I'm trying to say is that gold had a good run up, and I'm still kind of on the side that up until the point we don't get below 3,000, this is still a huge consolidation, which again, as I said, it could go ahead for weeks, if not months. But I'm just trying to feel a bit more, don't want to say bearish because it's hard to be bearish on something like this, right? But at least for now. But in the very short term, maybe I am, in the sense that I'm not expecting it to keep on going higher from here, but maybe a little bit of a slow consolidation while grinding slowly to the downside, something like this. It might be, right? Just as a concept, it doesn't have to happen exactly like this squiggly line would suggest. But I'm just saying this because if you check the the positioning, it looks like gold right now. It's just the most crowded trade. Everyone is long gold, and everyone up until at least I guess last week were mega bullish on gold. So that is usually the time where you have a little bit of weakness into an asset. Um, so just that alone would make me shift my expectations on gold at the current moment in time. It's actually a bit overvalued now, maybe at least standing to some report that you can find online coming off of, I guess it was Bank of America. Bank of America, it's just flooding the world with all the surveys and these type of studies right here, which don't get me wrong, they're funny to watch and to look at, and sometimes they're useful to be quite honest. But just because it's Bank of America, it doesn't mean that they get everything right. Okay, but in this case, I would lean on that side. To be quite honest, at least in the very short term, right? Especially because we have seen a lot of inflows into gold funds. So again, what usually happens when a lot of buyers and possibly the last willing buyers just bought, if you run out of buyers, what's left in the market? I mean, maybe not immediately and not with a huge magnitude, but sellers, right? So, bit of weakness into gold over the coming days and maybe weeks. But overall, again, up until the point we can maintain the 3,000 level, I'd say still a macro bull market for now. Okay, so I'm not calling for gold to crash back down below 2,500 or something like that. It's too early to talk about it. Okay, just to clear a point. Now let's move on to Bitcoin. Bitcoin was kind of non-eventful this week, I guess. I mean, sure, we tapped into the overhead resistance now, but I guess what was more interesting is that we got levels to the upside, right? We were thinking of a push to the upside uh, at around these levels, which were completely overshoot, right? So we moved on to the next relevant level where we found a bit of resistance, but even in this case, you see that we got back, we had a little bit of a retracement of a pullback, and we tapped into what was previously deemed as expected resistance, was completely smashed, clean break. We got back into it and we bounced off of it. So 1, 2, 3 times at this point. So we are stuck in between the overhead resistance right here and what was resistance first, and now it's been flipped into support. Very short term, what you could do is, well, you extend and project out these old levels. And what you could say is, look, at this current moment in time, as we've seen in the past, Bitcoin had a huge leg to the upside. So if it can just go sideways, that's nice for the bulls. It's your usual uptrend. Leg up, sideways, leg up, sideways, leg up, sideways. I mean, it's not bad if you're looking at it with some sort of all through bullish lenses, right? And of course, given the structure of this market, you should absolutely do it right now. So when these old type of order flow structure starts to break apart, or at least to shift to a much more neutral type of outlook, well, I'd say if we fall back below this level right here, all these areas. So if you want to draw, I wouldn't suggest that, but if you really want to draw a line in the sand, I should say 100K, because it's a round number, because it's a psychological level and whatever. If you see it, let's say, cracking below, at that point you might say, okay, so maybe at this point we go into a little bit of a period of consolidation, which could see, price moving to the downside and coming back up, then coming back down again, and staying relatively stable up until the point we finally break to the upside. Now, do I believe that's why it's going to happen? No, I mean, this is just my point of invalidation for the current, momentum of the market. But uh, same as we did in here, nothing says that you could just do the same. We keep on going sideways for a bit, a little bit of a test, and then we jump toward 115, 120, right? So actually, these would be a much more likely scenario up until the point these region right here can actually hold, right? So that would be Bitcoin in and of itself. So let's move on to yields first and then bonds, because beyond the simple price action, which again, same as last week, yeah, I mean this week we had a little bit of a move to the upside, especially in the long end, but actually this week it was a bit more generalized, to be honest. But we are still operating in that same macro range, in that dealing range we were discussing last week. But what I wanted to say about bonds, mainly two things, right? So one, since I've been asked, right? So, and it's always a nice exercise. So one is, uh, I'm gonna give you a little bit of a backstory, all right? That would be, I've always said, I think sooner or later, it might take a few months, it might take a year, it might go all the way down to 2026, but I think we are gonna see lower rates, right? Because I do think rates are just a reflection, or yields are just a reflection of inflation expectations and economic growth. So since, as we've seen from the CPI and PPI data, we are confirming this inflation, sooner or later, these yields should just catch up with that. As for the economic growth part of the equation, well, I mean, when you say that you expect economic growth to be weaker, everyone's starting to think about, oh, so you're calling a recession. Well, not necessarily, but I'm just saying that maybe economic growth, instead of being at 2.5%, what if it is 1.8%? Right? And let's say with CPI around 2%, economic growth around 2% instead of 2.5, 3.5, or whatever it would be kind of logical for me to see yields being around those levels. Now, you might say, yeah, maybe the long end of the curve, it could have a premium, right? The huge talks about the term premium, whatnot. So let's say you got inflation around 2%, GDP 2% slightly. Wouldn't be that bad to have the 10 years, let's say, around, I don't know, 3%, maybe, right? So again, I keep on thinking that way for now, but the other side of the coin might be, look, if it is true that these are tracking economic growth and inflation expectations, overall, if you do want to bet on the United States as for the economic growth into the future, if they're up, and if they're up with this type of a shape, so if you imagine the yield curve, you would have, if the long end keeps on going relatively weaker compared to the rest, you would have a curve which is steepening in a good way, all right? Where the long end is higher than the short end because, of course, you want to reward the long-term investors in bond securities or treasury securities for the amount of time that they are committing their money to it. And potentially, since they are demanding a higher yield, that would also include the fact that probably the economy is running well. Because, if you look at the opportunity cost, if you think the economy is going to be particularly fine, you're going to demand a much higher yield to park your money in these assets for 30 years, giving out or giving up on the potential returns you could have had by investing the same amount of money into the real economy. So productive investments, right? So at the end of it, could I be wrong? Absolutely. I mean, I've been wrong many different times, as you've seen. So that would just confirm that at the end of the day, the US would come out good from these all, mess that we are seeing right now with geopolitics, with tariffs, or with whatever. So again, just because you bet against the bond market in the US, well, that doesn't necessarily mean that you're betting against the US economy as a whole. Now, sure, there is still the problem looming about the debt, the deficit. The higher interest rates would have a much bigger impact on the fiscal deficit because in order to refinance the debt and to roll it over, you would need to pay more interests on it, which in time would add up to the collective amount of debt, right? So what I think it was funny to look at is that there are two things mainly. So I'm just gonna bring up the screenshots which I actually took from the web. So first of all, now people are starting to talk about stealth QE. Okay, so they say that the Fed just bought almost 15 billions in the recent treasury auction. And of course, they are making fun of them, calling not QE or stealth QE. So they have doing it via their Soma account. Okay, now without getting into the weeds of it, but this is false. All right, okay, that is not QE. It's still QT. You want to know why? Well, look, this is your simple explanation. So although they actually bought this amount of treasuries, you also need to remember that they are now committed to a QT regime where they target a 5 billion monthly decline. But you also need to remember that just because you issue a treasury, that has an expiration. Okay, so it just so happens that sometimes, like in this example, if you got 76 billions which are getting to maturity, all right, let's say in May, you're going to have 76 billions, sorry, which are going to leave the Fed balance sheet. But if your QT commitment is at 5 billion, right, there are 71 billions which are missing. So what you're going to do? You're going to buy up the difference. So again, yeah, they are buying it, but that doesn't mean that QT is stopped, right? They are just balancing out the treasuries which are getting into maturity and that for rolling off their balance sheet with their target rate as for the balance sheet reduction. That's all there is at the end of it. And even another false myth, they say when they got this report about the Treasury's auction going badly, going, well, it's just they say that probably it's because the Fed is intervening into them, and therefore the numbers that they show as for the Treasury auctions, they are better than what they would have been if the Fed wasn't interfering with them. And actually, no, because just read the last paragraph. All the statistics as for the Treasury auctions, they are made before the Fed purchases of bonds. So they don't affect the statistics at the end of it, right? So just a little bit of a food for thought. Instead of taking the mainstream narrative as as it is proposed to you, maybe, I mean, it's not easy. Sorry, it's not difficult. I can do it. If I can do it, you can do it. It just takes a few minutes. You could use whatever you want. If you don't trust Google, just use an AI agent, but you can actually find this information if you really want to. Okay. And then again, I was discussing this thing just the other day because we've seen that, I guess it was Moody's. Moody's just downgraded the United States debt. So I guess they brought them down from AAA to the lower brackets, the lower tier, which should be what, AA1 or AA plus. I don't remember now. So everyone, it's again, oh gee, the debt, no one wants to buy our debt. We are fucked. Okay, but first of all, check what it could potentially happen in the US. So as for now, I mean, it's been like that since '08 because the '08 crisis was put on the banks and their reckless behaviors, of course. So they implemented the supplementary leverage ratio, or SLR, right? So it's just a regulation which prevents the banks to take on a massive amount of leverage to avoid another 2008. Now, the problem with that is that if now you as the administration are faced with a problem, whereas you need to roll over the debt, but you kind of maybe worried about potential buyers, since for one reason or the other, Japan, China, so the major buyers and holders of US debt are not only they're not buying the same as they were before, but they're actually selling those treasuries. So you need a new buyer. What you do? Well, you could just change or at least loosen up these regulations a bit. Therefore, United States banks could be able to actually buy up the new issuance of treasuries. Now, what the main objection might be, why the banks should be so stupid, all right? I mean, would they buy treasuries, but what type of returns would they make on it, especially when you adjust for inflation and whatnot? Yeah, and I get it. For me and you, right? Let's say if you buy a treasury which is yielding you what, maybe like in this case, 4.5%, if you check the long end of the curve, right? Yeah. Well, the long end is almost at 5 now, but the 10 years it's 4.5. So again, from 4 to 5%, right? Why should I buy that if maybe I'm expecting that with this fiscal irresponsibility, inflation over the coming years, over the coming decade, it might be above that rate of return. I'm losing money. I'm losing purchasing power. For me and you, that is absolutely true. But because we are doing it with our own money. Do you think do you think banks are doing that with their own money? No. When was the last time you checked what type of active or positive rate do you get on your deposits? Let alone money market funds, but just imagine putting your money in the bank. No saving account, all the amount of checking accounts they got. I would bet you it's below 1% or 2%. So if I'm a bank and I'm collecting capital from the private sector by the simple fact they keep it on my books, right? And now I know that the average deposit stays on my books for 5 to 7, 8 years, well, that gives me basically the green light to say, you know what, I'm not even risking my own money, and I could pay these guys, so the depositors, 2%, and then with their money, I'm gonna buy US Treasuries, which are yielding me 4 to 5%. That is free money for the bank. It's an arbitrage which costs them nothing. They don't have to deploy their own capital, and they have the guarantee that the government is going to pay them up. So the question becomes, why wouldn't you do it? And even if you believe rates are going to be higher than that, would you expect, let's say, if rates goes to 6, 7, 8%, would you expect the amount of money that your bank is paying you on your deposit, it's going to go up that much? Or these arbitrage, some way, or one way or the other, it's still going to be present. And in that case, if yields keep on going higher, if you are a bank, given all the above, would you buy more treasuries, which are now yielding even more? And so, potentially the spread in the arbitrage, it's also it's widening, so you could make more free money. So, which is why I tend to believe, no matter what's going to happen to the price of the asset itself or to the yields, there is a buyer for US Treasuries. Just again, another type of I don't want to call it a rant this time around because I don't think it is. It's just, always try to put yourself in the shoes of the counterparty, or what do you think uh, should exhibit that behavior by which the movement in price action that you're expecting should unfold itself. Because sometimes you might expect that, although you could have a very logic theory, there's always the other side of the coin, and you should never discard it, right? So again, a bit of a pause, and then I'll get back to it with the stock market, because we need to build up two different cases for the stock market. But I just need to put a few things in order before getting there, right? Be right back. Having a look at the equity market, I mean, what we can see is that basically the week was completely a melt up to the upside, all right? I mean, no surprises there. We just witnessed the only one thing that the market was asking for in order to again switch to massively bullish. It started out with a trade deal with the UK. And as we discussed, I mean, it wasn't a huge deal in and of itself because the UK had a trade, the US had a trade surplus with the UK. But, I guess psychologically, I would agree with the fact that, yeah, but it is a good start. So if the market sees or starts to perceive that we are going to have these deals starting to go through, psychologically the effect would be good because the expectations of more to come will boost confidence in a kind of quote unquote roaring stock market. Okay, now we have seen over the weekend, and basically it was all reflected into Monday's price action, the announcement of the trade deal. Although it might be temporary, we'll see what's happened next. But for now, with China, okay, and the tariffs were hugely decreased. Now we were looking at what 140% type of tariffs before the deal, and now they have been brought down. I mean, it's kind of a bit up in the air, the actual level. Someone is saying 30%, someone is saying 15, as a in aggregate, Uh, but let's just stick to 30% if you want to take the higher estimate for it, which is absolutely way lower than the previous 140 plus percent. So the market just rallied throughout all the week, as you can see in here. We started out the London session on Monday was all up. We had a little bit of a pullback, and it kept on going higher, closing up the day to the upside. especially for the S&P. Now, doesn't mean that the other two didn't catch up. Actually, the one which had a bit more of weakness, especially on Thursday, it was the Dow. But then, as you can see by the reversal in the New York session, it just, huge Thursday US reversal in here, and then it continued into Friday. So overall, the stock market, it just kept on rally and rally and rally. Now, we had a bit of a weakness into the close. Uh, Again, just because it's the end of the week, and if you check the daily time frame, again, what we have been seeing is what I'm taking the Nasdaq, but you could take the S&P as well. I don't think it would be inappropriate. But what we've seen is 1, 2, 3, 4, 5, 6, 7. So again, 7 days of advances. We discussed last week it was 9, and 9 was kind of a historical type of amount of advances on a daily base for the market. So it might be a little bit of a natural type of ebbs and flows. It can only go up so much before having to cool off a bit and potentially pull back. But could also be that we are now getting into another potential pocket of resistance at this level. But nonetheless, the stock market performed particularly well this week. And you just look at the weekly candle, right? So we are getting back into the top, which was put in early in 2025. So the question now becomes, what is the reason? Okay, because of course, psychologically, the trade deal with China was the main driver in my view. But if you remember, last week we also discussed seasonality, and we've seen that overall May is kind of a good month for the stock market. June, it tends to be a bit more on the neutral side, and then you might have a bit of weakness in July. But if you remember, we were also discussing that May is particularly good in post-election years. So for now, that type of seasonality and historical pattern, it seemed to be confirmed. Now, again, at a point, remember that these market will have to pull back a little bit. It might be just shallow retracement like we have seen in here, right? These 2 days, it was May the 5th, May the 6th, and then we resume the upside. Or it could be just a bit of a sideways action, just to cool off a bit the overbought condition, right? Now, let's have a look at these layout like these. So again, we basically reclaimed what was anticipated resistance, both on SPY and the Qs. And now if you really want to draw another level, it could be this one right here as a starting point of the next cluster of resistance, right? So I keep on maintaining my bullish type of assessment as for the stock market for now, same as for Bitcoin, of course. I think, a very, very powerful reason to keep on staying that course is that, as again hinted at last week, we are full on in the buyback window period. So again, just to revisit a few data points we were looking at in the past weeks and months, buybacks are a really powerful buying force into this market. And actually, if you check, they are the main reason why the market goes up. If you start to look at what happened past the 2000s, so after the turn of the century, well, many other actors in this market, if you net out those flows like households or foreign investors, and you pair them up with pension funds and mutual funds, those flows, when you compare inflows and outflows, they net out and they're basically offset themselves. So what's left? It's basically the corporate buybacks. Some may argue that if it wasn't for the corporate buybacks, this market would be at least 30% lower compared to where it is right now. And again, there are very nice correlations as for the rate of change since when, I guess it was in 1982, where basically the Fed acknowledged that, corporate shares buyback, it is a form of market manipulation, but, they kind of said, yeah, I mean, we acknowledge it is, but we are just giving you the free pass on this one. So just go ahead and do what you want, referring to the big companies of the S&P, of course. And you can see how, if you check let's say the 4-week average percentage change, you know, there is a good correlation between corporate share buybacks and the rate of change of the S&P or the Nasdaq or the equity market in general. Okay, so if you really want to run some sort of a mathematical correlation, if you want to measure the R square and getting really nerdy with it, it's around 0.85%. So it's pretty correlated. All right. So up until the point that window is open, I would say I wouldn't bet on this market to be particularly weak. Now, we could discuss all day long if corporate shares buyback are actually a return on capital. As for instance, I would categorize dividends as a return on capital. Stock buybacks, uh, I see them more as a return for insiders, right? But nonetheless, doesn't change the fact that if it makes price going higher, if you're a speculator, you might want to take advantage of it. So there must be a reason why you do that, right? So if it's not strictly return on capital for the investor, what could it be? Well, again, market manipulation, as we've seen, because how do you value a stock, right? We got the price to earnings ratio and we got the earning per share, so the EPS. If you're a company and you buy back loads of your own shares, what's going to happen to supply? Outstanding supply. It's going to decrease. Therefore, if you decrease the outstanding supply and then you measure it up against earnings, well, that ratio, so earning per share, if you diminish the shares available, right, that ratio is going to be favorable. Therefore, will entice market participants to value the stock as a more, do you say that, appetible type of investment, right? So again, it's a bit perverse, but if you then check the numbers, these annual change in earnings is at the end of it the best indicator as for the stock market returns over time. So if you can manipulate the earnings per share by subtracting the supply of those same shares from the market via buybacks, then you're going to have a much better APS, therefore much better earnings, and people are going to buy your stocks, and therefore overall the index will move to the upside. So which is why I always keep an eye on the buyback window, and I want to see where we are at in that cycle. Okay, and if you pair it up with seasonality, we are gonna be in full-on open buyback window up until the month. I guess next earnings would be in July, so we might have the blackout window starting 20 days ahead of it. So probably up until June, we are gonna have this buyback window period opened up. Middle of June, I guess, something like it. I don't remember the exact date right now, but you can figure that out if you wish. Now, let's have a look at the usual chart we were looking at. So if you remember, we were expecting to see if volatility, in this case the VIX, could have getting back into levels which were below the 20 and below this trend line that we identified. Now it looks like we managed to get back below it. So volatility, it looks like it's no more a concern for the market. And when you look at moving averages, you see that, as highlighted last week, we cracked above the 200 days moving average and the 100 days moving average. So the next piece of the puzzle might be to see now that the 20 simple moving average crossed above the 50, if that keeps on going in the context where the 100 can stay above the 200, and in time these two on the bottom of the chart will manage to cross to the upside of the two 100 and 200, then you have the resume of your bullish trend. If you don't want to use simple moving averages, what you could use, it's just the usual exponential, but in this case, they are just depicting the same type of scenario, right? So again, although it might seem really hard to be bearish the stock market right here, right now, I guess we are still facing the same dilemma, right? So we've seen a huge drop in the S&P, okay, or the equity market in general. Now, this type of V-shaped recovery, if we want to zoom out, and let's use the weekly time frame for now, just for the sake of it, right? So we've seen something like this back in 2020, right here, right? And well, there was this kind of a 2018, but I mean, it wasn't the same type of a severe drop compared to 2020. But uh, you know, as for outliers, like let's take 2020, and then if you go back at the end of 2008, all right? So I mean, V-shaped recoveries, they can absolutely happen. Now, the recovery would be complete if we break for new highs, right? Now, one key difference is that if you check in the past what was paired up with those V-shaped recoveries, it was a huge amount of support, monetary interventions by the central bank, so by the Fed in this case. And it's clear if you check what was going on in the Fed balance sheet throughout those times and how the stock market responded to it as for the price action. Now we have a little bit of a different type of scenario, though. The setup is not exactly the same because the Fed is actually, again, as we've seen, still conducting a QT, not QE. So could this be that this time around we can have a V shape without the help of the monetary authorities or the so-called money printing, right? That remains to be seen. But the case for a V-shaped recovery is still up for now, although we lack these components that we had throughout the previous periods. Now, just remember that even if you start to look at reasons which should confirm a bullish trajectory for these markets in the coming weeks and months, you need to remember what was happening in the previous iterations. So we just had, if you remember, our preview, well, let's call it first negative print as for GDP. I don't know if I still have it in here. No, this is up to date with the new one. But, it was what? Minus 0.2, 0.3. Anyway, we got a negative print. Having a negative print followed by maybe another positive one to then go into a streak of negative prints, it's not unusual. And actually, we've seen that in the past. And coincidentally, right in the events that we were looking at, as for the two previous V-shaped recoveries, okay? So it was 2001, 2008, 2020. Of course, we had a streak of negative GDP, right, reads. But we also have periods where, let's say, we have just one print, and then after that it was just a bip on the radar, and then we resumed the upside. Now those periods, if I remember correctly, it was 2020, I don't remember if it was 2022. Um, might have been throughout this period, maybe. And then we got another one in 2014. It was around that time where we got the European sovereign debt crisis. I guess it was what was it? No, actually that was 2011. It was this one right here. In 2014, I don't remember what we got, to be quite honest. But I just remember looking at the data that we had some sort of a negative print, and then it was just a bit on the radar. So I guess, in order to have a little bit of a call on what the odds might be for a V shape to complete itself and seeing this market getting back to be massively bullish, or not having a V shape and maybe a market which it could go sideways for a little bit, or it could just God forbid retrace, and then we go in again back to potential recession scenario. One thing which we could use, it's the labor market, because back in those periods, so both 2008 and maybe the other one was what there was another one, probably the 2000 before oh 08. What was the other major collapse? Oh well, 2021, and then sorry, 2001, and at the end of it, we kind of had, yeah, even in this case, a bit of a V-shaped recovery at the end of it, but I mean, it dragged out for a lot of time in this case. So, I mean, if you want to bet on a bit more of a prolonged type of a downtrend, so in this case, no V shape, but actually a bear market rally, which at the end of it, it becomes, a rejection here and continuation of downtrend, you should look, I'm getting to the point, don't worry, at the labor market as for the jobless claims, maybe. So more people getting unemployed and staying unemployed for quite a bit of time. So you could look at the jobless claims in and of itself, the headline, or you should look at the 4-week average. So the continuing jobless claims. So how many people go to the unemployment line and stay there because they cannot find another type of job in the meantime. Okay, so I guess if you then go and check what is the current situation as for the labor market. Now, look, there are many different measures you can look at. All these basically. Now, again, I just brought up a few tabs, a few of these, not all of them. And for the sake of honesty, it might be that if you check them all out, you might find something which is massively positive for the labor market. Now, in this case, since I want to highlight the risks only for now, I just focus myself on what could be potentially damning for the labor market. But that doesn't mean that if you check them all out, you could find something which could support the opposite scenario. Therefore, the labor market to be completely resilient and stronger than ever, right? Just for the sake of intellectual honesty, right? Because I'm trying to present, both the case, as we have seen before, seasonality, buybacks, and whatnot, for a raging stock market, which is just keeps on going higher and higher, and a potential for a bear market rally. But then again, now that we have the tariffs shock behind us, we get back to think about economic realities, and we realize that, maybe the economy is not as strong as resilient as we might think. And although it might not be a full-on recession, still a little bit of weakness shouldn't bode well for the stock market to complete this V-shaped recovery. Okay, so let's have a look at these data. By the way, if you don't know the website, Trading Economics, it's just a huge source of these charts if you happen to care about them, or if you just want to check them out, right? I would suggest to you I would suggest you to use it. Even if you don't subscribe to it, I don't even know if they got a paid subscription. But by the way, I'm just using the free available content, so you can do a lot of things with it. So as for the labor market, when you check the United States unemployment rate as a whole, you see that overall it's not that bad. We are hovering around 4.2% at the current moment in time, which, historically, it's on the low side of the range. Now, again, you would need to go a little bit deeper into this topic about historically, because then you would have to adjust it for the population, for the participation rate, and many different other aspects, for demographics and whatnot. But just the pure number, it shows you that it's still at historical low rates. Now, if you zoom in though, over the last 3 years, we've seen that unemployment rate actually ticked up quite a bit. It went from basically 3.4 up to 4.2. I know it doesn't sound like a lot, but more often than not, in these data or in these charts or curves, as you want to define them, it's more of the trend. It's more about a trend than the actual number. Okay, so yeah, I mean, so you could say unemployment is ticking up a bit, but not vastly concerning at the current moment in time. Then if you check though at the unemployment as for the younger bracket of the population, then again, it's not really worrying at the current moment in time. But again, you see this trend going to the upside. Now, why did I take the time to check the younger part of the population? Again, because elder people, right? They when they retire, right? They got their money, they got their pensions. Oftentimes, they do tend to downside, and sure as hell, they don't want to buy a new house. They don't want to buy a bigger house. Maybe if before they got 3, 4 cars, now they downsize even on the car side, and now maybe they're just fine having two or maybe just one. So overall, they're not a huge boost to consumption. While instead, when you're young, you're young, you're in your 20s, your 30s, you are still, you know, uh, buying up your first house. You're probably changing your car every 2 years because you are using it a lot. Maybe you're building up a family, you're having kids, so your expenses are going to go up. There's no other way around it, right? So you're going to be a net positive as for consumption. And in an economy, which again is a 70% consumption driven, that matters like a lot. If you got a larger bracket or a larger portion of the youth, of the young bracket of the population going unemployment, that would hurt consumption on aggregate more than the older part of the population going unemployment, right? And again, you see it kicking up a bit, ticking up, sorry. Then what we got is full-time employment. Now, full-time employment, it's one of those data, as I was saying, I took it because it was some sort of an outlier in what I'm trying to describe. But, it seems particularly strong, right? It just came back up after the pandemic and it kept on going to the upside and it goes up and up and up. That is true. Although, when you think about full-time employment, you would need to adjust it for the participation rate, I guess. Because, one thing it's saying, yeah, we are saying full-time employment. Okay, but what amount of the total population of the country is actually, able to work, first and foremost, for whatever reason? Could be demographic, it could be, educational requirements, it could be whatever. But, you always need to measure that out, comparing it to the part of the population which is actually and actively seeking for a job. And when you do that, you see that, although, the full employment got back up to pre-pandemic level, the participation rate actually didn't. So again, is it full employment alone really giving you the whole story here? I'd say not completely. All right. Then we get into the jobless claims. Oh no, so these are the quits. Now the quits, why do you look at them? Because usually if you got an economy which is performing and running on all the proverbial 8 cylinders, what you might see is that people are continuously finding better jobs opportunities. So it's easier that they quit their current job to get to another one because maybe it's just a better perspective for their career, or they're just getting a raise as for the wage that they are able to collect. So when you see the quits rate going down, it means instead that people tend to hold to their job. It could be because they don't see any other better opportunity, or it might be because, when you start to see your neighbor going unemployed, you tend to think, oh, well, you know what, maybe I should just keep my own job. It might not be the job my dream, and maybe I would have dreamed of having a much bigger salary, but I look around and it doesn't look like if I quit this one, I might be able to find a new one, just, the snap of a finger. So maybe I'm going to stick to the one I've got right now, although it's not really the best I could have imagined, right? So this is why it might be important. It still gives you a bit of insight into, workers' behavior. Although, quite honestly, if you zoom in a bit, recently it ticked up a bit. When? Starting November 2024, so elections. So again, it might be that we are still running off this election euphoria. We are gonna make it better, bigger, stronger than ever before. It could be, and quite frankly, if you look at the overall trend, nothing really changed so far. Uh, so getting into the jobless claims, they are particularly low yet, so they're not really going to the upside or nothing like that yet. But this is why I was saying, if it is true that the labor market it's usually the last shoe to drop, when you look at the stock market and you try to assess your odds of success of a V-shaped recovery, the main thing in my view which could throw a branch in it, it's the labor market. So if you see these charts starting to tick to the upside, then you know something is up with it. And probably, since if you have less people with a job, you have less people with a wage, you have less consumption, it's less revenues for the companies of the S&P, less revenues should bring the valuation of the stock down, therefore people should start to the risk and getting out of stocks. But probably it's not going to happen overnight, but it's something which could happen, or at least it increases the risk of that happening, and therefore it decreases the odds of the V-shape and the raging bull market to reinitiate sooner rather than later. Here's what we were mentioning before, the 4-week average as for the jobless claims. As you can see, it was coming down. In 2025, it started to tick back up a little bit. Not huge again, even in here, but nonetheless, for now, it's another thing that you might want to check out up until the point it is stable and it doesn't crack. I don't know, let's say the 240 level right here, right? Then what we got is this. And I guess this is way overlooked in my view. If you check FinTwit or any other type of podcast that you can find on macro, this is basically average hourly earnings. So you might say, as we've seen, unemployment is low, full-time employment is high, but what if, yeah, you're still employed? Yeah, we're not seeing massive layoffs for now, but although you retain your job, you're earning less. So you're making less money for the same amount of time you commit to your ordinary job, which is, I mean, it's not good. And I mean, if you zoom out on let's go on the 10 years chart just for the sake of it. We got, yeah, we got the pandemic, then we got 2021. we bounce and then we are trending to the downside starting 2022. So this would kind of invalidate a lot of positive vibes that we might get from the full unemployment and whatnot, in my view, right? And then you could also check average weekly hours. So not only the amount of money that you make for every hour you work, but also the amount of hours of work that you make throughout a week. So when you look at the average early earnings and the average weekly hours, what you get as a scenario is basically a scenario where companies and businesses are maybe holding on to their employees, but in order to reduce the costs and to maintain the margins, what they're doing is they're making them working less hours or they're cutting the salaries. So how does it impact consumption and aggregate demand? All else being equal. I mean, in my view, not positively, right? And again, if you just look at the salaries growth, especially if you remember what happened after 2020 with inflation, yeah, I mean, for a while, salaries were going up while inflation was going up, and then they just started trending to the downside. So now the question might be, if you take this chart right here and you try to compare it with the rate of inflation as for the CPI, which I know it's a baggy measure and all the rest, but still it's what the market is looking at. What you might want to see is that, are wages really keeping up with the rate of inflation? So far, it looks like they are, because we are still, no matter the downtrend, but we are still at 3.25%. With inflation, which has been below 3% for quite a while now. So that wouldn't be a massive red flag for now, yet. If you're betting on a booming economy, maybe you would like to see it go in the other direction, right? And then lastly, because I realized I've been bored you enough at this point, that is the Challenger job cuts, it's called. But basically, if you read into here, you can basically see it's basically the amount of layoffs which have been planned, announced, and then probably executed. Now we had a massive uptick into it because, as it is described, because of the Dodge, right? But it looks like after peak, we now got back down to levels which are a little bit more in line with what we were looking at throughout 2021, 22, and 23 and 24. So that little bit of a spike, and then it just got back where it was. Now, what's the point of all of these charts? Again, it's basically to assess whether you should bet on a V-shaped recovery and be massively bullish over time on the stock market or not. So, if you say, of course, you can think differently. It's really not mandatory that you see things the same way I see it, but I think the odds for a V-shape to be completed and a raging bull market over the coming months, let's say, for the rest of 2025, if I had to pick right now with the data that we have available right now, I'd say I would be more on the side of a retest, probably even higher highs, maybe, who knows. But after that, I would bet on a little bit of a market which is going to be stagnant. Especially after June, or getting into July, and then August, September, I would expect the market to be a bit more choppy and not necessarily repeating what we've seen, I don't know, in 2023, 24, right? That would be my take on it. Uh, sure, macro things, they take a while to play out, and they can always change, right? That doesn't mean that just because you got this picture now, you would bet on this scenario now, it couldn't change into the future. All right, but you know, today that's where I would put my my eggs if I had a basket to put them in. Now, could this be again? Remember, I'm not discarding the market to make new highs, right? I'm just saying, even if we make new highs, I would expect diminished returns overall year over year. So not a raging bull market, but probably a market where at whatever level you see it, it might be a more choppy, right? And a much more volatile. So we'll see how it plays out. This is just me with the data that I'm looking at right now. And of course, as usual, this is not a static concept. This is not a static word. It's constantly changing. It's evolving. So the flow of information is always there for you to look at. So even if you have a base case, always be ready for the opposite scenario. As I told you about, the yields and the bonds, right? Just because you have a premise, that doesn't mean that at a point it reaches into your invalidation point and you need to reassess things around. Okay, so that is pretty much it for this week. Yeah, probably it was a bit boring to look at the different labor market data and metrics, but I guess it was conducive to establish the odds or potential odds, probabilities of case A happening over case B. All right. And with that, I'll leave you off, wishing you a good weekend, a good Sunday, good start of next week. And as usual, be nice and be cool. Neil's out.
Let me tell you something. There is no nobility in poverty. I have been a rich man and I have been a poor man, and I choose rich every fucking time. Because at least as a rich man, when I have to face my problems, I show up in the back of a limo wearing a $2,000 suit and a $40,000 gold fucking watch. Fat boys, duke it out. Hit him. Hit the fuck off of me. Now, if anyone here thinks I'm superficial or materialistic, go get a job at fucking McDonald's, because that's where you fucking belong.